The current stock market surge is reminding nervous investors of the 2000 dot-com bubble burst. However, there may be a better and slightly more recent stock market climb to look at for comparison. Today, we have an easy money Fed policy, interest rates that are near zero and will likely remain low for an extended period, and a yield curve with credit trends and money availability far different than the 1999 to 2000 timeframe. But when we hear the pundits talk about high valuations, they often compare the stock market with the stock market of the dot-com bubble. What if they're all wrong? What if the current market is not like the dot-com bubble? To be open-minded, maybe we should look to another historical example to explain the current market surge. Okay, let's take a look. Getting straight to the point, maybe what we are experiencing in the market is more like the post-dot-com burst and is really more like the 2009-2010 recovery. If the current market is similar to the 2010 recovery, we could be looking at a solid year for the market. Maybe we'll have some volatility, but we could possibly be looking at more upside. And looking at this chart here, you can see the S&P 500 moving off its March lows of 2020 are quite similar to the rebound off the March lows of 2009. Through the February 2nd close of 2021, that is 218 days after the March 23rd low of 2020. During that time, the S&P 500 is up about 71%. Now, in the 218 days following the March 9th, 2009 low, the S&P 500 was up about 70%. At the February point in the post-2009 run, the S&P 500 began a pullback. In the current market, we had a small pullback, but the S&P 500 has generally continued to march along, and we just logged record finishes. So although the 2020 chart movement has diverged several times from the 2009 path, we just might continue on in 2021. Oftentimes, when you have so many looking for a pullback, the market likes to prove everyone wrong by doing something quite different. Another thing to think about is that since the start of the current earnings season, the fourth quarter 2020 year-over-year earnings have improved by about 11.9 percentage points. This is the fifth largest improvement on record, dating back to the third quarter of 2002, but it is matched only by the 2009-2010 recovery. So let's now go to our charts to see what the current situation looks like. What we just talked about is only one possibility. But getting back to the charts here, and we're looking at a 12-year monthly chart on the spiders, the SPY, you can see that at this elevation here, 390.51 is quite a ways above the 20 and the 50 EMA. So a 5 to 10% correction is easily possible. We had a good correction there, here, and here, coming down to near the 50 EMA, and perhaps we only need to come down to the 20 EMA, and you can see several of those corrections here, not quite down to the 20 EMA, but certainly small corrections of, say, 5 to 10% is easily possible and probable given the elevation. Now, when we go to the volume, it looks fine, but as you can see here in the MAC is extending well above the zero line. We're at 23.85 on the fast line, and that's probably the highest reading that I've ever seen going back decades. So given this level, it's easy to see that stock market gravity might take hold and we could come down. Not quite in the cards yet, at least by the monthly chart. Moving on down here, we still see the acceleration in the histogram as well, heading on up there. Into the price rate of change, we see a little bit of sawtoothing, which could be a sign of a topping process there. But now into the RSI, This is always my problem. This is the weakest of all the oscillators, but it's one of the more important. Now, this trend line here, we have broken above there, but given where the MAC is and given where the price chart is, this RSI is relatively weak. Into the stochastics and then the Williams, you see pretty much the same thing. You can't really tell too much from that because I think we're a little bit premature now. But going back here to the price chart, given the levels, I think the risks are more on the downside than on the upside. My opinion would be not to do any new buying unless you have a screaming deal. Otherwise, just save some cash for that opportunity that will come up. And for today, that's ChewDog Charts. Thank you.